Over the past several years, the American economy has been the envy of the developed world. The United States has consistently outperformed its peers in terms of GDP growth, productivity, and wage increases. Additionally, inflation, which had reached concerning levels, began to decline significantly in 2023, hitting a low of 2.4% year-over-year in September. However, recent developments indicate that the U.S. economy may be entering a more uncertain and precarious phase. Consumer confidence has fallen sharply, the trade deficit is widening, and inflation remains persistently high. While official economic data will not be available for a couple more weeks, the Federal Reserve Bank of Atlanta's GDP Now model, which provides real-time estimates of GDP growth, suggests that U.S. GDP could contract by a staggering 2.8% in the first quarter of this year. Given these concerning trends, it is important to examine the factors contributing to this economic downturn and evaluate the extent to which the policies and actions of the current administration may be playing a role in this situation. One of the main reasons the Atlanta Fed believes the U.S. economy is teetering on the edge of a recession, if not already in one, has to do with the fundamental components that make up GDP. Typically, GDP is calculated as the sum of four key elements: consumer spending, private sector investment, government expenditures, and net exports. Recently, most of these components have been weakening, with the most significant decline occurring in net exports, the difference between exports and imports. The primary driver of this decline in net exports has been a dramatic surge in imports. This increase in imports appears to be driven by what economists call front-loading, where businesses stock up on goods in anticipation of future tariffs. Essentially, many companies expect trade restrictions and import taxes to be implemented in the near future, so they are preemptively acquiring the supplies they need before those tariffs take effect. While this strategy allows businesses to avoid future costs, it also creates an imbalance. Imports are rising, but exports are not increasing at the same pace. Mathematically, this results in a lower net export value, which negatively impacts overall GDP growth. This situation has been further aggravated by the strength of the U.S. dollar. As global investors anticipate higher tariffs and possible interest rate hikes, they have poured money into the dollar, driving up its value. A stronger dollar makes U.S. imports cheaper, encouraging even more purchasing from abroad. Although this front-loading effect is somewhat expected in the lead-up to new tariffs, it has nonetheless contributed to economic instability and is a factor that policymakers should be aware of. However, the trade imbalance is not the only concerning factor influencing the GDP figures reported by the Atlanta Fed. Another major issue is the sharp drop in consumer spending, which had previously been a driving force behind the U.S. economy's outperformance relative to other developed nations. Recent data from the Atlanta Fed suggests that year-over-year consumer spending growth has fallen to nearly zero, a significant drop from the 2% growth rate seen last year. This decline in consumer spending is consistent with findings from major economic surveys, such as the University of Michigan's Consumer Sentiment Index and the Conference Board's Consumer Confidence Index, both of which have recorded steep declines in recent months. The University of Michigan survey, which tracks consumer sentiment on a monthly basis, found that confidence among American consumers dropped significantly in February. A major factor behind this decline appears to be inflation expectations. That is, how much consumers expect prices to rise in the coming years. The survey found that consumer inflation expectations for the next 5 years are at their highest level since 1995, which suggests that Americans are bracing for continued price increases. Similarly, the Conference Board's Consumer Confidence Index also recorded a sharp decline in February. The most concerning aspect of this decline was in the Expectations Index, which measures consumer outlook on income, business conditions, and the labor market over the short term. According to the Conference Board, the Expectations Index fell below 80 for the first time since June 2024, a level historically associated with an impending recession. Business sentiment is also showing signs of weakness. The Institute for Supply Management's ISM Manufacturing Index, which measures economic activity in the manufacturing sector, indicated that U.S. manufacturing stagnated in February. The only factor preventing outright contraction was the same front-loading of imports mentioned earlier. This means that once businesses finish stockpiling goods, manufacturing activity could decline even further, adding to economic concerns. Another troubling aspect of the current economic situation is that consumer spending is becoming increasingly dependent on the wealthiest Americans. According to research from Moody's, the top 10% of earners now account for an unprecedented 50% of all consumer spending in the U.S. Since overall consumer spending has stagnated and the share of spending from the bottom 90% has shrunk, this suggests that the vast majority of Americans are already experiencing recession-like conditions. This growing reliance on the spending habits of wealthy Americans also means that the stock market plays a larger role in determining overall economic health. Typically, stock market fluctuations do not have a direct impact on the broader economy. However, when the wealthiest Americans, who hold a disproportionate share of financial assets, are responsible for sustaining consumer spending, stock market declines can lead to reduced expenditures. The recent downturns in equity markets could discourage these high-income consumers from spending, further increasing the risk of a recession. It is important to recognize that not all of these economic issues can be attributed to the current administration. Some of the consumer spending seen in 2022 and 2023 was fueled by pandemic-era savings, which have now been largely depleted. However, many of the economic indicators that have deteriorated in recent months, such as consumer confidence, business sentiment, and inflation expectations, have been directly linked to concerns over new tariffs and trade policies. These concerns have also been reflected in political polling. While overall approval ratings for the current administration remain low, approval ratings related specifically to economic management have seen a particularly steep decline. Recent polls recorded the worst-ever net approval rating for the administration's handling of the economy, with a 12 rating, while another survey by Ipsos showed a drop from +4 in January to 8 in February. Another key challenge facing the economy is inflation, which has proven to be more persistent than expected. After reaching a low of 2.4% in September, year-over-year inflation has steadily climbed back up, reaching 3% in January. The introduction of new tariffs could further exacerbate inflationary pressures by making imported goods more expensive. In response, the Federal Reserve may be forced to keep interest rates higher for longer or even introduce additional rate hikes, something that could further slow economic growth. This potential for tighter monetary policy may explain why the administration and its allies, including prominent figures like Elon Musk, have recently criticized the Federal Reserve. Lastly, concerns about the national debt continue to loom over the economy. During the campaign, the administration promised tax cuts but did not outline any significant spending reductions to offset them. Initially, there was some hope that cost-cutting measures would help balance the budget, but that no longer seems likely. Even the administration's own estimates suggest that it has only managed to reduce spending by a few $billion, an insignificant amount when considering the federal government's $7 trillion annual budget. Furthermore, the latest Republican budget proposal, which has been endorsed by the administration, is projected to add at least $2 trillion to the national deficit over the next decade. Although borrowing costs have remained relatively low due to investor demand for safe assets, this situation is not sustainable in the long run. The U.S. government cannot continue borrowing indefinitely without facing economic consequences. Overall, while it may be too early to definitively declare that the U.S. is in a recession, the economy is facing its most uncertain period in years. The combination of slowing consumer spending, declining business confidence, persistent inflation, and rising debt levels creates a fragile economic environment that will require careful navigation in the months ahead.